Hey everybody, this is Alex from Be the Trader. Today we have a very special segment for you. We have three great traders. We have Stephen Ducks, Tim Grittani, and Matt Owens. Guys, welcome to the show.
Hello.
Hey,
Hello.
thanks for having us.
Absolutely, absolutely. And so, today's segment, we really want to dive into one main topic, and it's something that you all have in common, and that's tracking data, Excel spreadsheets, just that big thing a lot of people talk about and have trouble with, it seems like, in the community for new traders. So to kind of start this off, when you think of tracking, what's the first thing that you start to ask yourself before you track?
I would say winning percentage. That if you want to find a pattern, you need a very good, at least 70 to 80% winning percentage overall throughout the year. And also, it's not people don't know how to track, is they don't really know. Once they track, they don't know how to use it. So the data they're tracking, they don't know how to use it at all. And to really, I would say, use the data to your advantage when you're trading, you have to split them into different like sections you want to trade. You have to split them into, okay, this pattern only fits 4 criteria, this pattern only fits 5 criteria. Then you want to comparing them, try to find out, okay, so if the pattern only fits 4 out of 5, then it's not really tradable. You will reduce the winning percentage. And also by tracking, you want to find the reward, average reward. As soon as you place a trade, you want to know where to exit to be able to, know where you can take your profit. Because the majority of people, when they are shorting or going long, they're very confused about how to really take profit. And they will always ask, if somebody put alerts out there, they will spam you with 1,000 questions of where the exit is. So that's one of the problems that people have to overcome with by tracking statistics. So.
Yeah, and for me, the first thing or the first things I'll think about when I'm trying to track a new setup, I guess for me, it just starts with what information do I need? Like, what do I want to gather? What would be the useful data to collect? Things like market cap or outstanding shares, maybe like a yes, no column for is there something dilutive present? And then, yeah, kind of going back to what Duck said, I do want ways to kind of track, potentially what would my risk be, what my reward be. So I just have to have like in my mind a clear idea of what is the setup that I'm looking to track and just what do I need to get useful information.
Okay. And you, Matt?
Oh God, this is a hard question for me. So what I do is kind of what Ducks and Grittani do, but I do it on a much broader scale. So I will take a data set, like let's say daily open, high, low, close data across 20 markets, okay? Because I'm not just trading stocks, I'm trading commodities, currencies, index futures. And then I will put that into a system that I built that will scan for, let's say, 5,000, 10,000 signals. And then I will try to find something that works across markets. And I am not really attached to any kind of win percentage or something like this. And in that sense, if I find something that does work, it needs to have a decent win percentage, anywhere from like 50 to 70. But as you go up through the win percentages, at least in the markets that I trade, um, it comes at a cost of, okay, the average like ratio is not 2 to 1, it's like 1 to 1, and that's not great. But if I accept something that's like less win percentage, so let's say it's like 51%, but the trade-off bias is, okay, it's 2 to 1 or 3 to 1. And so then that's something that's more intriguing to me, because if I leverage, let's say, $1 million into that strategy that's trading across 7 markets, I reduce my risk by doing that, but I also increase my reward and my payoff is much higher. So my drawdowns will be small but frequent, but my payoff will always be exceptionally high. And that's more like, and that's also strategy dependent too. If I'm looking for something more short term, I will accept something that wins 60 to 70% of the time. That's kind of sweet spot, but I'm only holding maybe for 1 to 7 days. I don't trade longer than 7 days on anything. And that's because if you go past 7 days, you have a shorter time horizon. You can't predict really that great past 7 days. The edge just falls off the curve. So
hey guys, I just want to take a moment to share with you some awesome news. I just started a newsletter, and you're probably like, what's so awesome about that? Well, it's not your typical newsletter, because I'm going to give back to you, the people who subscribe to the newsletter. Number one, you will be getting updates on my YouTube exclusive videos, the podcast episodes, and articles and blogs all about trading. But how is it different? I'm going to give back to you guys. I'm going to select randomly different subscribers who are in the newsletter and give them either the opportunity to have a one-on-one call with me. Maybe I'll give them a free trading book, one of my favorite trading books, just to name one, Trading in the Zone. And also, and not only, because there's many, many more ideas that we're going to be doing and implementing. But another idea is maybe win the Billions box set. There's a popular show on Showtime, Billions. If you don't know about it, definitely look it up, because it should be everyone's favorite show if you're a trader. At least it's one of my favorites. So I want to give back to you guys, because you guys mean a lot to me. And I just don't want to only provide content, but I want to say thank you, right? And I provide content by saying thank you, but I also want to say thank you by giving back. So thank you guys, and you guys take care. So something that you all guys have mentioned is y'all went straight to like different things that you're tracking, right? Like maybe Grittani, you're going to track market caps. Maybe with, you just gave examples. And then, yourself, Dux, you'll say you want to track a win percentage. And then Matt, you like to track the real broad scale. But how did you get to that conclusion? Like, did you just wake up and say, you know what, guys, I want to track all market caps with the warrants? Or did you track everything and then figured out this shit doesn't work, so I'm only going to track this? Like, give me an idea of what got you in the mindset of what you specifically track, and why do you track that rather than tracking all of it? Unless you track everything, like, Dux.
So first of all, I would say I started track when I see something that's happened pretty much very frequently. And also I trade, back in the days, I usually don't really track statistics. It's assumed, for example, gap up short, and it happens pretty much all the time. And you kind of see that happens very frequently, and also you generate large risk reward. So the thing that comes to my mind is I pretty much always screw up on gap up short. Either you take a huge loss or you make a huge gain, but the gains can overrun the losses. But in that way, you want to kind of perfect your strategy. So you want to go into the gap up short, track the frequency, the average reward, and the winning percentage. Those are the three major factors you have to track. How many times it happened per year? Happens about 70 to 80 times per year for gap up short last 3 years. Then winning percentage will be around 70 to 75%. Then reward will be typically around the 1 to 2.5 or 1 to 3. If you can get the top tick. So once you get the three major factor down, you want to go into details, which will be different market cap zones. Market cap will be 0 to 100 million initially, then 100 million to 200 million, then 100 million to 500 million to 1 billion. Then flow, different zone as well, under 1 million, then 1 to 3, 3 to 5, 5 to 10. And you can kind of see that in different market cap zones, for people who doesn't really track statistics at all, you can clearly tell that a bigger cap level 2 is completely different than a smart cap. So that kind of gave me the idea of, okay, I want to put all gap up short in the same market cap and flow zone. So I can be able to generate very similar predictions and how they're supposed to perform in the next 30 to 45 minutes. So that's my general structure for tracking statistics.
I appreciate that. What about you, Grittani?
So I guess for me, I start off just assuming I don't know anything. So I do want to track as many different things as possible. And I guess I kind of start off by looking at things that you hear other traders talk about. So, for example, if you hear people talking about float rotation all the time, that's something I might want to track for every single setup and put it to the test. I have no idea when I actually have a large sample size if float rotation is going to matter at all or not. So I usually start off just casting a really wide net, adding like every single thing I can think of. And then as I get more and more data, I will start to see, okay, maybe float rotation doesn't mean anything at all towards this setup. And if I do reach a point where I think I can draw that conclusion, then I'll just delete that column out of my spreadsheet and just have a little bit less to track all of a sudden. So for me, it's always just been cast a really wide net every single setup and then just narrow it down as I go, as I see things that might impact it versus just have no impact whatsoever.
Cool, man. And Matt?
Yeah, so I started off the same way where I would like look at something that I would see and then I would program it and then test it like on the data set. But then I kind of moved more towards what Tim just said, which is I took like all the technical indicators, everything anyone has ever said, programmed that, put it in a signal, and then do a mass search across data sets or similar data sets. So like penny stocks would go in one category, bigger market cap stocks would go in another, future indexes would go into another, and try to find common things between them that worked. And that's just how I do it now. But back then, for sure, I started off just like looking at things or reading about something and then testing it and programming it and just looking at one data set. So, and then I evolved more towards an approach of, well, I don't really know anything, so let me just try everything and just see what happens. So
cool. No, I appreciate that, Matt. And it seems like there's like a common thread here, and it's mainly, find either A, you see something that's noticeable, something you've seen before, or it catches your attention because you've been watching the markets. All of you guys have been watching the markets for quite some time. And then you might want to test that. Like Grittani, you just want to say, assume right away, you don't know anything about this setup, so you're going to track everything. And then over time, you start to see what works and what's important. So I appreciate you guys all sharing that. Now one thing that y'all mentioned during that explanation, though, is the idea of data sets, how many you track, like over time, you start to see that this isn't working over time. So the question that comes to mind is, how do you track in terms of how many, like, are you just tracking every setup you see? Are you tracking, are you back testing? If so, what are you doing? And then and then along with, how many do you recommend for yourself? Like, I know some people say they want 50, 100, 100 plus. Just give us an idea of what you want to see before you even start trading something.
So I would say to start off, very minimum 100 samples for each pattern. And what was the other question again?
How do you get
it
that?
Was so many questions.
Yeah, it was.
Yeah, good.
You gotta keep up. You gotta keep up. It's how do you get to that 100 samples yourself?
Okay, so at first, a lot of people doesn't really track. They only track the successful setup. They don't really track the failed setup. Mm-hmm. So I would recommend that you set a couple criteria for yourself. And as soon as you see the pattern that meets the criteria, you become that pattern. Either it works or not, you still track it. So you will still track the failed samples and the success samples. Then once you have 100 samples, I think you're good to go. So as long as the winning percentage is over 70% and risk reward ratio will be 1-to-1 and frequency anywhere above 50 times a year.
And you, Grittani?
I agree with Dux with, it needs to be probably at least 100 for a sample size. Early in my career, I had a lot less, and I think I was prematurely drawing conclusions on some setups. But Matty's probably the better person to ask for what an actual statistically.
Oh, here we go. Matt's going to say I developed some alien technology that tracks thousands of setups, and then it gives you in 1 minute.
Well, part of the problem is with a lot of these setups, they perform differently in different market conditions. So, I mean, earlier this year, multi-day breakouts were absolutely insane. And there was if you only track multi-day breakouts for a few months, you would think this is the best setup in the world that never fails. Whereas the last 3 months has just been a slow bleed out for my strategies, at least. or as far as what I've tracked. Now, as far as getting to that sample size of 100, for a long time, I would only forward track. So I would get an idea. I would, see some pattern in the market and say, I want to learn that. I want to get good at that. And I would just start tracking that day and every day forward until I'd gotten enough of the sample size to be comfortable to start putting some small amount of money on the line. Now, recently, I have been getting a lot more into data tracking. I've grown up a little bit in terms of where to look for data. So when it comes to back testing, I'm still a little paranoid about maybe taking past data and then overfitting a bit. But just to get the basic data, I know there are sites out there where you can run some pretty basic scans or things like that. Like if I wanted to go and return like any stock that closed up 50% or more on the day, for example. I think there's a site out there called Spitkey. I might have butchered that pronunciation, right. But like I know I could go there and I could request that, and I could get a decade worth of data at least on any stock that closed up 50% or more on the day. So that's a tool at my disposal also if I want it.
And I think, Matt, whenever you start explaining, Matt, your way, I think if you could also touch on the point where Grittani was saying how the idea of looking at backtesting using past data. But I remember you were talking on my show not too long ago how you also forward fail test it. So if you can talk about that too for a moment with that explanation.
Yeah, so this is a very complex question for me to answer, and I will try to do my best to keep it simple. But here's the deal. Every single market that you encounter, you have to categorize it of what it is. Penny stocks, futures, whatever you're looking at. And each market is going to have its own characteristics. And therefore, what you find in one market is not necessarily going to be an ideal thing to do in another market. And so people always ask me this question of sample size. It is highly dependent because remember, you as a trader are an anomaly hunter. Okay. What does that imply? That means that if you had 50 samples versus something that has 100 samples, you have to ask yourself a question, which one is better? Okay. And like, sometimes sample size doesn't mean a strategy is better than something that's smaller. So that brings up an interesting like paradox where do you let the law of large numbers play out, which is what most people go with, or is it something that has enough samples but is more infrequent or what we call low latency? Okay. Now, given that pretext, okay, it's highly dependent on the strategy itself. So if I am trading something that is intraday, I want 500 to 1,000 samples of that. And if I'm trading something that is more long-term in nature, I will accept something that has 80 to 100 because I am now more trend following. And by definition, I would then have a much longer time horizon and more infrequent trades. And how you can bolster sample size is something that Dux glossed over that he does. But what he does is like he does the same thing as me. If I go into the S&P 500 and I only have 80 trades, and then I add that to, let's say, the Dow Jones Industrial, okay, and that gives me 100 trades with the same strategy. They're both index futures. They're both correlated. So when I combine those together, now I have 180 trades. Where like if I was doing what Dux was doing and I said, I'm looking for gap up short, I can go into any stock and try to find as many gap up shorts examples to equate to that sample size. Now, because I'm data mining, okay, what I will do is I will take 20 years of data, okay, or penny stocks. I've done this on penny stocks too. I will take, let's say, as many sample sizes of supernovas, let's say, okay, and I will have, 500 tickers, okay, that are all supernova patterns. So I'll put it in and then I'll see what common strategy emerges from that. But I will also withhold, let's say, 30 tickers to test that on after I do in-sample and out-of-sample testing. Or in the S&P, it's much more simple to explain. I'll take 20 years of data. If I'm looking at intraday strategy, I'll have anywhere from 500 to 1,000. But let's say I withhold 2017 to 2020. So I do in sample, the strategy is built on in sample. Let's say I cut that in half, which I do. I cut the data in half. I make a strategy on in sample. I test it in out of sample. And then once I'm comfortable with all of that, I will then test it on 3 years of data that was never in the testing period. And now essentially that is the real-time performance of that strategy. And then I will watch that strategy for 6 months to trade in real time. And then if I like it, I will put actual money behind it.
Interesting. Now, one thing I want to ask you guys, and one thing we're going to do on this show today is we're going to there's going to be a couple of questions near the end of the show where I believe Nate put a question out there on Twitter and had some questions come at us, and we want to answer some of those questions for some of the listeners. But before we dive into that, we have one last thing, and this could be real simple, or I'm hoping it's real simple, but it's more of, now you've got your data, right? Everyone's got their data. You've got your number of 100 plus, whatever it is, actual stocks that you tracked. The question is, how did you guys, and then maybe you already knew how to do this, and if not, where did you learn? Because I'm sure a lot of people are going to ask this question, or maybe they're scared to ask this question. Maybe they feel intimidated. But like, okay, I have all this data, Dux, Matt, Grittani, but how do I freaking use it? Like, how do I use Excel? Like, how did you learn how to actually use the data? Like formulas, is there certain formulas you love to use? So that way someone could be like, okay, maybe I'll go research how to use that. You don't have to teach anything like formulas, but like give some ideas of like formulas that helped you out in Excel or whatever document you use.
For Excels?
Yeah.
There's a bunch of tutorials on YouTube. So I think it's pretty easy to use.
Okay.
And you don't really need really, really complicated functions to really get the results you want. And as I said, 3 general structures: frequency, reward, and winning percentage. It's pretty easy to get that without going into complicated functions.
Cool.
That's just my opinion on it.
Grittani?
Okay. So what I will try to do, I'm just going to use something like afternoon breakouts as an example here.
Sure.
So I gather all my raw data and I want to figure out, was an afternoon breakout good or not? So what I'm going to do is I'm going to put in just a simple formula for like what was the high a day minus the breakout point divided by the breakout point. And that's going to tell me what percent did it run from breakout to high a day. And then I'm going to, have some number in my head, like 15% or 20%. And there's something in Excel called conditional formatting, where you can highlight that entire column and you can highlight every single one that, was 20% or more from breakout point to high a day. So now they visually stand out, the ones that I would say were successful, like, oh, they had a nice volatile move after the breakout. And then I will take other columns and I will just sort them, highest to lowest, and kind of look for clusters like in that breakout to high column that I've got highlighted now. So, if I sort by market cap and I'm seeing all these really successful ones down in the low market cap area, like under 50 million or something. And then as I keep scrolling down to higher and higher market caps, there's fewer and fewer ones that are popping out that were big runners. That might say to me, you know what, like at this certain point, I might want to start ignoring any that have a market cap of, 200 million or more, just for example. And I'm kind of just looking for like visual cues like that. And It may not be the most statistically significant way to do things, but it has produced good results for me.
Cool. And Matt?
Yeah, so I started out with Excel, and then I kind of moved more towards programming because I just wanted to invest the time up front and then never have to do it again, really. That's my main motivation, because by nature I'm lazy. And so I learned off of reading books that at the beginning, there were very few. I mean, I was 18, so that was 2008. Python really wasn't a thing. And, I had taught myself Excel and, some programming, just playing around with Python. And But there's a lot of free stuff now that when I was first learning how to do anything, there was not that much. And obviously, if you can see behind me, I have books on machine learning. I have how to build video games in Python. I have all kinds of stuff. So it's just a lot of research, reading, and then just trying to stay on top of it. But nowadays, you guys can get anything almost for free, even illegally if you really want to. So.
Okay. So to wrap this up, guys, with like the last 10 to so minutes, I'm going to go ahead and ask a couple of questions from some of the people on Twitter. And one of those questions is from Scott Schmitz. He goes, I would like to know two things. One, when backtesting stocks, and I haven't even looked at these, so we may have already answered this, but when backtesting stocks, is there a platform that will do it without coding or by hand? And then number two, when forward testing an edge, is it only trades I take or any ticker that you see the edge appear in? Anybody can answer this. It doesn't matter. It to just take one person, really.
Okay. For question number two, I think it's, I wouldn't say only trades I'd take. If I'm trying to track a certain setup, I want every single time that setup occurred. So, not just the ones I saw. I want to make sure I've got a complete sample size. For the first question, as far as if it takes coding to backtest, I kind of mentioned the Spikeep site earlier, which is like where I'd go to try to get old data. But I don't do any kind of like automated analysis of that data or anything like that.
Okay. And
yeah,
go ahead.
I don't understand this person's question, because in order to create something that can backtest, like you're going to have to do some kind of inputting and most likely programming. You can use a platform like TradeStation or Trade Navigator where it comes with built-in like strategies, and then it has an automatic backtester. Like you basically put it on the chart and then you click a button and it will pop it up for you, but that's all programmed in a language. Or you could use Excel, but you're going to have to put in the data, put in what you want, and then put in the graph. And then the forward testing question is like something we just talked about, which is you can withhold data, and then once you do in-sample, out-of-sample testing, you could then put that strategy on the data that it never saw, or you can just track it in real time, which is what they both do, which is more real time of like, okay, I have the strategy and now I want to just see it actually perform, before I do anything with it. So
the next question is, would love to hear more on turning an idea into data-backed edge through spreadsheets. So this might be something we already talked about. Would you agree? Do you agree?
Yeah.
Then let's move on. 5 most important pieces of data to track on each of your own trades, and 5 most important pieces of data to track from the market while learning a new setup.
I feel like we've already answered
I think the main thing is what pretty much we've all said, like track everything, really act like you don't know what you're doing. And then after you track everything, you'll start to see what you need to actually focus on, what you don't need to focus on. And I think Grittani kind of laid that out earlier. And then on a long, how do you know if it's a pullback and not a failed spike, or vice versa if you're shorting?
I got that one. Because it's something I'm starting to track and use the data. Like if you see something, like take any day's big runner, and there might be 2 or 3 times along in that day where it looks like it had a hard crack. So like the way I would track that is I would say like, okay, what was the fake high day? What was the low of that pullback? Like when it looked like it might be in trouble. And then I would know ultimately, oh wait, that came back and that broke to new highs. So if I just take every big runner I see, and I'm looking at, every fake crack it had along the way, I might be able to quantify, like, is there a certain percentage, relative to how much it's already up on the day that makes this chart broken versus something that can be recovered from.
Perfect. Anyone want to add to that before we wrap this up?
I track it in terms of the dense of volume. So when the stock is likely to perform like a failed breakout, or like it's going to crack and drop 20%. I value it in terms of, okay, how much support is underneath to really help that drop. So let's say if there's like 300 million or 3 billion in terms of dollar support, and it's only 5% under where the consolidation is. And as soon as they crack that 5%, that 3 billion will definitely lift that crack up. So that's something that I value in terms of support. I don't really look at in terms of like how many times you try to crack throughout the day. And also for shorting, same thing. I will track the average. I will track the maximum dollar can be traded in a certain market cap. Let's say the maximum dollar can be traded under 100 million cap will be 1 billion. And today's stock is trading a lot of volume and nobody knows where it's going to go. And you kind of have an idea of, okay, this is the maximum I can trade in average. So I will value it, see, okay, well, today only traded about 300 million in terms of dollar and 1 billion is the maximum. So you still have tons of potential to go. And as soon as it cracks, it might be a fake crack because there's potentials in there. But if it's already trading 900 million on consolidation, it's very close to that 1 billion and it cracked. That might be a real crack because it's the maximum of something you track. Yeah.
Cool. I appreciate that, Dux. And Matt, if you have anything you want to add before we wrap this up?
Not that would be conducive to the conversation.
No problem. Well,
because it's okay. Let me try to be a nice person. Okay. Support and resistance is in some ways subjective. And in that sense, by you drawing a line on the chart or looking back and saying, yeah, this was a high, and then drawing a resistance band, or this is a low, and drawing a support band underneath of it, that is 100% subjective. And although you can use it as a reference point as a trader, you still need more information. And you also have to ask the question, just because something was there in the past doesn't really have any effect on the present. And so something you really have to think about before you harness your, hook your ideas to that. Like why, besides it was a high of the past, why is that important? And it's like, oh, well, maybe most traders were there. Well, maybe. So you need more information, which is why I've even said in your thing that I really like Duck's volume approach, because what that's actually doing is it's deriving meaning. So if you have an idea of resistance, and you're more concerned about the bid ask and how many float rotations are happening around that resistance point, that's more useful because now you're looking at market participants, and therefore the edge isn't really coming from the resistance, it's coming from that. And that's, everyone gets lost in that. They're always like, support and resistance is important, and it's like, not really. It's the other information that goes along with it that derives your edge. So
cool, man. I like how you wrapped that up, because I was actually going to point that out. As soon as you said that, I was like, well, that's like Ducks. So I appreciate that, man. And look, guys, we appreciate you guys being here, being able to answer the other traders' questions and providing value to all the traders out there in the community. You all do a great job on your own channels, on your own YouTubes, and just providing great content through your services. Real quick, to wrap it up, what is one way, if you can just name real quick, Dux, Grittani, Matt, the best way for these people to find you if they did have questions?
You can find me on Twitter. Also can find me. I post the majority of my content on my YouTube. So just type Steven Dux, you will find it. That's pretty much it.
Yeah, my Twitter, Croner89. Be careful with all of us on Twitter. I think we all have multiple.
Yeah, we do.
If you get a message that looks like it's from one of us being like, hey, send me Bitcoin, it's not us. So
And mine is at Triforce Trader, literally on every single platform. That's what it is. So
great. And mine's Be the Story 87 on every platform as well. So thank you so much again, guys. And you guys have a great day.
You too.
You too.